Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm joined by Marc Jocum, investment strategist at Global X. He's going to talk to us today about the continued growth of the ETF market and about Global X's newly launched ETF, the A300. Hi Marc, thanks for joining us.
Thanks for having me, Anna. It's great to be here.
The first half of 2025 has been marked by market volatility, yet ETFs in Australia have continued to be popular and attract flows. From your perspective, how has the environment shaped the way investors are using ETFs?
ETF adoption continues to grow. There's a couple million investors in Australia using ETFs at the moment. And if you look 10 years ago, there was about a third of the products available. Right now, there's about just over 420. And there's products around different asset classes. So when you talk about, this year being a very volatile year, it was a volatile year for equity markets, but some other asset classes really performed quite well. So for people who wanted exposure to things like real assets like gold or cryptocurrencies or different types of fixed income, there was an ETF for that. And ETFs have shown time and time again that they can handle market volatility. They've been around now for over 20 plus years, at least in Australia, even longer overseas. They've been through the dot-com boom, the GFC, COVID, and most recently Liberation Day. So on a given month, ETFs trade around about $10 billion per month. But when markets are volatile, they tend to trade a little bit higher, closer to 20 to 25 billion. And ETFs really become a source of liquidity. They become a source of price discovery as well. And this year, we're on track for the best year ever for ETF flows. So far this year, there's been $27 billion going into ETFs. We're going to absolutely smash the record that we saw last year, which was $31 billion. And it's pretty much on track for about $40 to $50 billion this year. So even though markets are volatile, it's still been a really, really strong year. And I expect this to continue for many, many years to come.
Your mid-year report talks about investors leaning into resilience, diversification, and smarter quality exposure.
Yes.
So how is that playing out in ETF demand? And what types of exposures are being prioritised? Are people leaning more into niche or broad-based ETFs?
It's a great question. And I think when we were talking about with investors being a little bit more tactile or specific, prioritizing quality has been important. And when you're looking at different types of factors when it comes to ETFs or what's known as smart beta, they've really taken a lot of adoption. So at the moment, around about 25% of flows into equity ETFs are going into these smart beta strategies. 10 years ago, it was only about 10 to 15%. So we're seeing a lot of investors use these types of factors that were traditionally reserved for active management, but can now be packaged in a low-cost wrapper like an ETF. We've seen a lot of take-up in our growth at a reasonable price ETF, GARP. A lot of people were worried about valuations, but they still want growth. So GARP's been one of our fastest growing ETFs as well. And not just that, but people want to hedge market volatility. They can do that for things like covered calls, things like commodities. And on your niche exposure, the bulk of flows are still going to broad-based ETFs. So at the start of the year, Europe was outperforming. So we saw a lot of flows going into Europe ETFs and less into the US. And now we're starting to see a little bit more shift back into the US, but also investors are complementing their broad-based exposure with the niche thematics. And that's where Global X is a leading issuer in thematic ETFs. We've seen a lot of interest in things like defense technology, artificial intelligence. So it really is a bit of a barbell approach. You have the core of your portfolio in broad-based ETFs, but some of the satellites or the exploration side can be in some of these niche thematics. So we're seeing growth in both sides of the market.
Okay, so you've recently broken down your hits and misses in your halftime scorecard. So if we dive into that now, if you can talk about your MVPs and also what your misses were.
Yeah, so starting off the year in 2025, we had four main themes. The first was around US exceptionalism. Secondly was about AI and the monetization of AI. Thirdly was about real assets to be a hedge against potential stagflation. And the final one we had was being a little bit weary of valuations and having a bit of a valuation discipline, given where markets were quite expensive. And most of it did play out. So when you talk about our MVPs, the US was exceptional. It started the year underperforming other markets like Europe. But in the end, once you saw Liberation Day come and a lot of these companies still driving meaningful earnings, the US is exceptional. Over 80% of companies in the S&P 500 have been in earnings in the most recent earnings season. So that was probably one of our key MVPs. Another one as well was gold, precious metals. So in the wake of potential stagflationary fears, people worried about the fiscal deficit, inflation will it actually be put back in the genie bottle? Gold's up 20 to 30% so far this year. continual purchasing from central banks, a hedge against uncertainty. It was a perfect environment for that. And then the other side as well, where we were very bullish on, is on AI. You're seeing this clear divergence between AI stock performance and non-AI stock performance. And it was even Jensen Huang from NVIDIA who said there's only going to be two companies that exist, either ones that are using AI and ones that don't. So that monetization piece is really important because AI was kind of experimentation. Now it's about execution and monetization. In terms of the misses we had, there were probably two. The first one is we thought there'd be a bit of a market broadening within US small caps. That didn't happen. There was a bit of macro headwinds, elevated cost of capital, so small caps didn't benefit. And we thought the US dollar would rise, but the US dollar has fallen about 10 to 15% so far this year. It's not necessarily a bad thing because a lot of the big tech companies in the US actually denominate or receive a lot of their revenue outside of the US. Tech companies receive about half of their revenue outside of that. So because there's been that FX tailwind, it's actually been very good for their earnings overall. So have been some hit and misses, but overall, we're still pretty happy with how things have played out.
Let's talk about your new fund. Global X has just launched the Australia 300 ETF.
Yep.
What was the thinking behind creating this product?
Yeah, I mean, we're very proud to launch this product. It's currently the lowest cost ETF, offering exposure to the largest 300 companies listed in Australia. There hasn't been an ETF like this in this broad category for over 7 years. So we feel this is a real game changer. We want to be more relevant in client portfolios. We were talking earlier about us being a real pioneer when it comes to commodity ETFs, launching the first gold ETF in the world back in 2003. We do thematics really well. We want to do more, and we want to do more in the core space, in the broad space. So for us, it's about being more relevant to client portfolios. And we've seen that over the last 3 years, over $20 billion has gone into broad-based Australian share ETFs. And we weren't capturing a lot of that. It was really about having these conversations with advisors, with clients, to really be a core part of portfolios overall. We want to be relevant. We want to be seen as a premier ETF issuer rather than just a small player in the market. So there's a lot of money still going into ETFs, and we just want to be part of it.
Most broad Australian equity ETFs stop at the top 200 companies. So what advantages do you see in taking that extra step to include, the next 100? Are there examples of smaller companies in the 2 to 300 range that have already, illustrated the benefit?
Yeah, when you look in the Australian market, the most quoted index would probably be the top 200 that people benchmark against. But we feel there's a lot more value to have that broader scope. Because if you can get broader diversification for, if not the same fee, a lower fee, that's a good outcome for investors. So when you're looking at the 200 to 300 end, you're looking at the more smaller companies. Now, some of these companies are a little bit more volatile, but a lot have really strong growth profiles as well. And if you look in terms of the last decade, there's been over 100 companies that have graduated from that 200 to 300 band into the top 200. And I've read some research that shows that this graduation effect might actually, once a company graduates into the top 200 or the next index, it actually loses some of its potential outperformance. So you see at least a really strong performance leading into the index inclusion, but then it kind of softens out at the end. So for a lot of investors, they might miss that. And there's been companies like NetWealth, Hub24, ProMedicus, Xero. These are all companies that have graduated. Now, for a lot of investors, the Australian market is home to some of companies that are doing really, really well, but aren't in the 200. DroneShield is a very, very popular company, up almost 400% this year. We'll probably get included in the 200. We're recording this in August. And obviously these indexes rebalance, but that was one that wasn't in the 200. Catapult, they do a lot of sport analytics for a lot of athletes. They up 75%. Domain Holdings, they got a takeover bid earlier this year, also up 75%. So it's really having exposure to those broad-based sectors, maybe not being so top-heavy in some of the big banks and financials, which are technically the most expensive in the world, and just having a bit more of a diverse base across holdings in Australia. And we also wanted to have something that a lot of people can performance benchmark against. Superannuation funds benchmark against the ASX 300. So for us, having that broader scope was very important when bringing out A300 to the market.
You mentioned a lot of very popular stocks
Yes,
there amongst the Livewire audience. So how do you see the A300 fitting alongside the best global equity index exposures?
Yeah, so about half of the ETF market is now in global equity ETFs. It did start off the ETF market as Australian shares and commodities, and it's definitely shifted because a lot of Aussies are either holding Australian shares as a single stock holding and they wanted to get global ETF for that global diversification. When you look at the global ETFs, a lot are concentrated in things like technology, consumer, communication sectors, which is pretty much underweight here in Australia. So for people who have global equity allocations to the US, to Europe, to parts of emerging markets like Asia and India, the A300 ETF does still have that overweight towards the financials, the banks, the materials sector. Yes, it does have a small allocation, around about 5% in the portfolio to the small cap side of things, but it really blends that allocation nicely across different sectors. A lot of Aussies still have that home domestic bias. For investors who are using whether it's single stocks, active managers and paying 1% in fees, which in my opinion is far too expensive for broad-based exposure, you can actually get that with A300. So it really does form that core pillar in client portfolios to have both your Australian equities allocation in something like A300, your global share allocations, and then to explore on the fringes of the portfolio.
You mentioned cost just
Yes.
then. So A300 is currently the lowest cost ETF tracking the 300 largest Australian companies. So how important is cost in the ETF space, and what impact can low fees have over the long term?
It's incredibly important. I always say that the more fees that you can keep in your back pocket, the better. Because fees are like these little ants or little termites that nibble at your returns every day. So if you can get rid of them and exterminate them, again, more returns for the end investor. And if you look at the average Australian equity fund manager, as I mentioned before, they're charging about 1%. So the fact that we can do this as a 1/25th of the cost of that and do it to give exposure to broad-based companies like the Australian 300, it makes a lot of sense for people. There's definitely this movement towards low cost. A lot of people talk about active versus passive or active index. I actually don't agree with that. I think it's really about high cost and low cost. And you're seeing around about 2/3 of flows going into funds in the ETF land, charging less than 0.25% per year. That tells me that Australian investors, they want broad-based exposure, but they're incredibly fee conscious, right? Now, some of the new ETFs coming out to market might look a little bit more expensive because they might have a different thematic focus, a bit more niche. Some of the active fund managers are coming out with an ETF wrapper, but overall, the weighted average cost of ETFs keep falling. They're down to around about 0.33% at the moment, or 0.34%, and I think that will continue to fall. So for us, coming out with a very, very low cost option, A300 charges us 0.04% per year, was incredibly attractive, and we're just trying to appeal to investors who want low cost investment solutions.
Finally, what type of investor is the A300 best suited for?
We feel it's suited for a range of investors. You've got your everyday retail investor who just wants to start getting into the market. We're currently going through earnings season at the moment here in Australia. Some single stocks might have a lot of volatility based on that. For people who want to move away from single stocks and just get access to the broad market, because most stocks do underperform the broad market overall. Some stocks fall and never recover, and most active managers don't outperform a broad-based index like an Australian 300 index. So for investors who just want low-cost exposure, that's one. Financial advisors or people who are building model portfolios and are looking for a core allocation to Australian shares, if they want to move away from active funds or funds that are charging more than what we're charging, they can look at a low-cost core allocation, particularly for the broad-based equities, and maybe use some other managers on the side. And then the last one is potentially some institutional adoption. It's still very small here in Australia in terms of ETFs being used by big institutions. But I mentioned before, the APRA performance benchmarks use the top 300 companies in Australia. So for a lot of these managers who are benchmarked against that and want to have a tight tracking error, using a low-cost solution like A300 could be really attractive because you're getting exposure to a very, very similar benchmark and you're doing it for a fraction of the cost. So for us, if you can, like I said, remove the fees in your portfolio, you're just left with the market beta at the end of the day. And that's what a lot of managers are planning on doing because most of the returns that you can get are formed from asset allocation, not so much on the security selection or market timing side. So we feel that A300 appeals to a multiple range of investors, and that's why Global X just wants to be more relevant in Australia and be more relevant for more investors.
Thanks for sitting down with Livewire today. It was lovely to chat to you, Marc.
Thanks for having me, Anna. It was great to chat.
Great. If you enjoyed that interview, make sure to give it a like and don't forget to subscribe to our YouTube channel where we release new content every week.